Hey everybody, this is Dan Sheridan. I'm doing a supplemental video to Matt's excellent Reverse Iron Condor video that he did last week. A link will be included in this video. I want to give you a little bit teaching and addressing some of the issues. Here's the test that Matt went over, and you can see it here. It's called a floating reverse iron condor since dailies. It's going from May 16th, 2022 to August 3rd, 2025. And you can see your call is going to be at the money. This is 0 day, buy a 0 day at the money call. And you're going to buy a put a little bit out of the money. You'll see this 0.25% out of the money. So buying an at the money call and buying a little bit out of the money put. And you say right away, what's that going to get you? You'll be a little bit long deltas because you're getting a bigger delta on your at the money call, smaller delta on the out of the money puts. It's going to be a little bit long deltas. And you're basically selling your call and your put. It's going to turn out to be about 30 points away. You can see in an example here where we're at on this. All right. And then in terms of the entry, we'd open the trades between 10:30 a.m. and 12:30 daily. Use exact DTE, 2.5% of portfolio. We want to allocate. When you're back testing, you want to try different allocations, some higher. It could really kind of magnify like max drawdown and other things. So it's good to do different ones. But here's what's interesting. You want to do this on, it says VIX on a move down, minimum 0.01, and then VIX move down minimum 1% during the day. Now, it's not a big deal. I mean, if VIX is, 20 times 1%, it's 20 cents, right? So it's not a big deal. But you generally want to do this when the VIX is down. And we'll get to that in a second, why you want it with the VIX down. And we'll get to that in a second. But testing this, you could see a really good MAR, 67% win rate. This goes back 3 years. Drawdown isn't bad, 6.2%. Starting capital, ending capital, and a decent amount of occurrences. Trades 188, winners 126. And this is on a negative theta trade. So this is pretty impressive. This is a negative theta trade. Now we're going to go under the hood of the car in a second and see why. But here's just an example from 3 months ago. But it gives you, this is going to be somewhere in the vicinity of $9. And you can see it. This one was put on at 10:34 a.m. Eastern. You have a window of 10:30 to 12:30. And you can see on the longs, you're basically buying your long call close to at the money. You're buying your long put generally 15, 20 points out of the money because you can see here 0.25% out of the money there. And your shorts are pretty simple. They're going to be basically 30 points up and 30 points down from where you're trading at. And you can see here's the parameters for where you would place your short strikes. And we're going to talk about the shorts in a second, a little bit more. But that's kind of the overall. Like in this example, the first one, July 25, paid $8.70 debit, sold it out for $13.64. You had some movement. You had some movement up from $63.76. 63.89. It expired. So we only needed, in this particular example, about a 13-point move up, and you made $3,400. If you scroll down a little bit on this, we'll pick another winner and then a loser. Again, starting it here was 63.27 when they opened it on July 23rd, 10:30 in the morning, paid $11.10 debit. And you can see we bought the 63.10 puts, about 17, 18 points out of the money from 63.27. And then you buy about the at the money call. And then in both of these, you sold, again, here you sold the call, about 35 points out of the money. Here you sell the call 35 points away from the short call. So 35 points out of the money from the long call. And then on the put side, we bought the 63.10, we'll sell the 62.80. So sometimes it could be a little bit different, but it's 30 to 35 points away the shorts. That gives you a feel. Now, when lost, here's one that lost. On July 8th, it got triggered at 10:33. We were 62.30. You bought the at the money 62.30 call, bought the 62.15 put, 15 points out of the money. sold your calls 30 points up and your puts 30 points down. But the way we lost, it only moved 4 points. So it expired right at the money on a negative theta trade, and you lost on that one, right? So what I want to do is put a little more color to this. And if you look, here is the trade right here. Here's an example of the trade. And you can see here the beautiful graphs here. And I was looking at this. I mean, we're pretty close. We were about 67.45. Now we're at 67.49. So you can see I went in and set this trade up today. You say, Dan, why did this trade get triggered today? Okay, remember the criteria. Remember the criteria. What was the criteria? Between 10:30 a.m. and 12:30, I did this a few minutes ago, so 12:36 here. So when I was modeling this, it was within 12:30, and you wanted the VIX down minimum 1%, which is about 20 cents or something in the VIX. And right now, as I'm looking at the VIX is for the morning, for right now, VIX is down 53 cents. So that's more than the 1%, right? So it opened down. That was one of the criterias to open down minimum 0.01. And then during the early morning period, that floating entry, we wanted a minimum of 1% down in the VIX. So that would trigger the trade. If that wasn't met, if the vol was up, we wouldn't do it, right? So the trade is triggered. But a couple things I want to point out. You could see that this trade, part of what makes it test well over the last 3-4 years, it's long delta. You say, what do you mean it's long delta, Dan? Well, if you look at this, let me just get the Greeks for you. If you look at this, our deltas are almost 40, 45 right now. Negative theta, so there's red, right? I'm going to show you that in a second, how that will expand. You want this thing moving because it's a negative theta. This isn't a range-bound trade. It's positive vega on this trade, positive gamma. So we're going to get longer deltas on the way up, shorter deltas on the way down. Now, you notice this, the short-long ratio 0.1. The reason it's so small is because in this particular case, by selling your shorts 30 points out of the money, they're trading at like 20, 30 cents. There's nothing there. If I wanted to get this higher, instead of going like 30 wide between the long call and short call, or long put and short put, I'd go 15 wide. And that would raise the short-long ratio. I can show you that in a second. But the second thing is, if you look at here we are right now at 1220-ish, or as we're going north a little bit more. Watch the graph as I keep going further the time, getting to 1 o'clock. You can see that sea of death in the middle of this red because you're negative theta. If we're not moving, right, we're goosed, right? We're going to be losing pretty good money. What we want is we need this to go up here, right? Get to the green area, which is about 67.54 or more as the day progresses. So you can see at the end of the day, we start getting here 67.54, 67.60, right? You can make quite a bit. And you see we're at 67.49 right now, right? So we're, right now, we're at the door of prosperity. That sounds a horrible thing to say, but it's true. You're leaning pretty good long deltas, and you can see we're right here, 67.48. All we need is 5, 6, 7, 10 more points here, and you're getting into the green. If we were to actually move like 20 points or so, you could double your money. So now if we go back down, that's the problem. If we go back down, What's the problem? You're getting in the sea of death and you can lose quite a bit. So, but again, this type of trade is leaning long deltas, and the way it's situated, the short-long ratio is pretty low, 0.1. I might do this a little narrower, but again, in an, at a 3-4 year period where the market's going up, the reason this tests well is because it is leaning long deltas, because it's very difficult to get a negative theta trade to work well in back testing. So thanks, everybody. Have a nice day. Thanks.